Hello and welcome everyone to my channel, The Quality Investor. As I study high quality businesses, there's one aspect that I study a fair amount, and that's the dividend. I love dividends. There is a warm and fuzzy feeling you get every time that dividend hits your account. And I use the dividend reinvestment program, DRIP, to immediately buy new shares every time I get a dividend. However, not all dividends are created equally. And on today's episode, I want to discuss those differences so that we, as quality investors, can buy businesses that are appropriate for our investing goals. There is a debate in the investment world over the best dividend strategy. Some investors only scroll the list of dividend aristocrats and only add those. Some focus on high yield dividend stocks, and some focus on dividend growth over everything else, and some focus on a combination of all three. So, what is the best approach? What are the differences? And above all, how do we make sure we buy high quality businesses first? Before diving in, if you enjoy content like this, please hit that like button and subscribe to the channel. Also, please hit that notification bell so you can know right away when I post more stock analysis content. On this channel, I always stress research, knowing the business, and holding for the long term. If you're using your hard-earned money to buy something you expect to grow in value over many years, something you want to hold on to for many years, quality of investment is paramount. With that, let's talk about the first dividend strategy. Just simply buying dividend aristocrats. To become a dividend aristocrat, a business must meet the following criteria. Be an S&P 500 member. Maintain market cap of $3 billion. 25 consecutive years of dividend increases. And finally, maintain 5 million daily share trade value for 3 months prior to acceptance. So it's not easy. These businesses really are the best of the best. There are currently 67 dividend aristocrats. Most recently, in Q4 2023, Walgreens, ticker WBA, lost their status as a dividend aristocrat when they cut their dividend. However, yesterday, Fastenal, ticker FAST, raised their dividend and should now be the newest member of this elite club. Also, FactSet, ticker FDS, is on pace to join later in 2024. But is it a quality strategy to buy this whole list? Assume you have $67,000 to invest and you decide to put $1,000 each into every dividend aristocrat. Just set it and forget it. What would your return be compared to the S&P 500? Better or worse? Are you better off just buying an S&P 500 index fund? The answer underscores the importance of research and understanding the business. Investing is fun, and this channel is for those that love the exhilaration of picking their own stocks. However, to do that, we must chase quality above all else. If we don't, we're simply leaving money on the table. Luckily, there's an ETF that tracks just the aristocrats. It is the ProShares S&P 500 Dividend Aristocrats ETF, ticker NOBL. Let's see how it performed. Okay, so we're looking at a snapshot of that ETF right now. You can see the ProShares S&P 500 Fund Noble, and it's up today about 0.38%. Not too bad, although you can see the S&P is rip-roaring today at a 1.18% jump, and we're about half an hour from market close as I record this. We also have a dividend yield of 2.1%. and an expense ratio for this ETF of 0.35%. So it's not a high expense ratio, but it's also not a low expense ratio. You're going to lose a little bit of capital with that expense ratio. So the question is, it's not performing as well today, but how has it performed historically against the S&P 500? Well, let's take a look at year to date. Well, year to date, it's lagging behind a little bit. You can see here that starting here on the 2nd of January, and going through today, we have a 1.4% for the S&P 500 versus a negative 1.1% so far for the ETF fund. So far, it's not off to a good start in 2024. However, how about in the last 5 years? What has the return been for the last 5 years against the S&P 500? All right, here we are looking at the 5-year chart, the S&P 500 in green versus the Noble Fund in blue, and it's still lagging behind quite a bit. You can see the S&P's done 81.13% over the last 5 years in total versus a 48.37% for this Noble Fund in total. However, the last 5 years have really been dominated by the Magnificent Seven, the tech sector. There's not a lot of tech companies inside of the Dividend Aristocrats. So, maybe if we look at 10 years, it's performed a little bit better. Let's see. So here we are on the 10-year chart, and you can see the S&P in green and the Noble Fund in blue. And if you bought it exactly 10 years ago today, you would be lagging behind a little bit after 10 years. After about 2.5 years, you'd be pretty well ahead, 32.19 after 2.5 years or so, versus a little under 25% for the S&P. But through today, the S&P has returned 171.3% over 10 years, whereas this fund has returned 123.68%. So you can see over the last 10 years, if you've owned the Noble Fund, which is just the S&P 500 Dividend Aristocrats, you would have been lagging quite far behind the S&P 500. The fundamental problem with most Dividend Aristocrats is growth, or really lack thereof. To be clear, they have stood the test of time. I mean, after all, the reason they are on the list is because of those 25 years at least of consecutive dividend raises. The Noble Fund has yielded a respectable 2.1%. But in my opinion, dividend investing is more than just collecting passive income. It is also a hedge against the most silent of killers, inflation. And many aristocrats fall short here. My rule of thumb when it comes to dividend growth is 5% minimum. Anything below that, and you're losing purchasing power with your dividends. This is especially true if you're retired and you rely on dividend income to fund your daily expenses. We saw rampant inflation in 2022 and 2023, and anything less than that 5% dividend growth just doesn't cut it. So let's discuss some other aspects of growth. Okay, what we're looking at here is a list of all Dividend Aristocrats as of the end of 2023. And right now it's sorted by our enterprise value, the 10-year compound annual growth rate. I also have sales, earnings per share, free cash flow per share. Those are the 10-year compound growth rates of each. Of course, each of the dividend growth rates through 1 through 10 years here, the dividend yield, return on invested capital, the 10-year average, and the most recent return on capital employed. And so what I want to illustrate initially is just the slow growing nature of these businesses. As you can see, I had it sorted by enterprise value, the 10-year compound annual growth rate. And it looks pretty decent for the top 18 so far. We have all the way from 22.9% compound growth rate down to 10.2. But you see pretty quickly after the 19th Dividend Aristocrat, it stops growing at a 10% rate here. And in fact, if you go all the way down to the bottom of the list, there's not a lot of very great growth here. And you have some pretty big names on this list. Johnson & Johnson, Colgate-Palmolive, we have IBM, ExxonMobil, and of course, Walgreens Boots Alliance, who was a Dividend Aristocrat at the end of 2023. They're no longer. 3M, we all know about the legal troubles they've had. And a lot of these have even lost value. And you kind of look over here at the bottom of the list, you can see the sales, the 10-year compound growth rate for sales. Let's sort it by that. You can see not a lot of these are growing their sales that quickly. I like to see sales at least a 7% 10-year growth rate, because that means the sales over those 10 years doubled. And you can see if we scroll to the top, it's actually not that many companies that grew their sales at faster than a 7% rate. So many of these companies, they're not fast growing companies. And if they're not going to grow fast, they're not going to create a lot of cash flow. And if they're not going to create a lot of cash flow, they're not going to create a lot of great returns for investors. Now let's look at dividend 1-year growth here. So it's sorted now by dividend 1-year growth. And I said earlier in the video, I like to see about a 5% year-over-year dividend growth. And we come down to the bottom here, 28 total Dividend Aristocrats raised their dividend by more than 5% in the prior year. So that means 39 Dividend Aristocrats raised their dividend at a rate less than what the inflation rate is. So you're losing that purchasing power, and that's not a good place to be in. Now, sorting on the 10-year dividend growth rate here, we can see there's quite a bit more companies that have rose by more than 5%, 50 in total, increase their dividend over the last 10 years at a 5% rate per year. So that's a lot better than the 1 year. But what the 1 year is telling me is that a lot of these companies, they're slowing down the amount of dividend increases they're giving out. Basically, it's very tough to continually to raise your dividend continually year after year. It does put a strain on companies' cash flow. And the final column I want to look at here is ROIC, or return on invested capital. Now, I like to see about a 15% average and return on invested capital over 10 years. And you can see here, there's plenty of companies that are hitting that. In fact, S&P Global, Automatic Data Processing, Expeditors International, Clorox, Lowe's. I actually own Lowe's. These are some excellent companies. So a lot of these companies are doing a very good job allocating capital, which in turn generates good return for investors. But like I said, about a 15% minimum ROIC. And if we come down to where that cutoff is, that's at 24 companies are currently averaging over the last 10 years, 15% ROIC or better. So what this is telling me is that these companies will generate a good return, but as a portfolio, it may not generate a great return. And let's come down to the very bottom. Let's just look at the averages, a portfolio average for all of these. We can see, if we had an equal weighting, of course, of all of these businesses in our portfolio, sales, 4% growth over 10 years, 5% growth for earnings per share, 5% for free cash flow, dividend, not terrible. All of them are right around 6.5%, a little bit higher, up to 8% for the 10-year average dividend growth. So that's actually not bad. It does yield well. A 2.6% dividend yield, a 14% ROIC, so right around average. Nothing great, but nothing terrible either. And then again, ROCE, or return on capital employed, at 16% on the average. I like to see ROCE at about 18% or higher. So I want to posit that a fund of just Dividend Aristocrats is actually a below average fund, as evidenced by what the S&P itself is returning. You're actually better off buying an S&P 500 index fund and holding on to that, and you'll do better in the long run than you would a fund of just Dividend Aristocrats. Simply creating a fund of just Dividend Aristocrats, it will grow over time and it will pay a serviceable dividend. However, this is not the most optimal dividend strategy in my view. For a portfolio of just very stable, slow-growing businesses, ones that might have stood the test of time, maybe have a little bit of less downside risk, this isn't a terrible strategy. But if we want capital appreciation, if we want that real growth, not only in our investments, but in our dividends, there are better strategies out there. This wraps up part 1 of my dividend investment strategy series. For part 2, we will discuss the merits of dividend growth investing versus high yield dividend investing. So please stay tuned for that in the next day or so. So as a reminder, this is not financial advice, and I always encourage you to do your own research. With that, thank you for watching today's video. And what do you think? What kind of dividend stocks do you like to own? Please let me know in the comments below. Also, please like and share this video. And if you found this content helpful, consider subscribing to the channel. Thank you and happy investing.